Yes, this is Patrick. Um, Bear with me for a second while I get our slides correctly in view. Uh, Today we're going to be discussing Chapter 2, which it really is the beginning of where we're really getting into corporate finance. We're starting to discuss accounting data, and this is important, as I believe I mentioned last week, that we're going to be using the principles of what you've discussed in accounting, the data from accounting, and the theoretical principles that yeah, you were introduced to in economics. And blending those two subject matters together, you really get finance. So these two chapters today are mainly going to be a review of a few things, but some of it may be new as well. And the chapter is really going to begin by discussing company write-offs. The old text had another example, but they're discussing how home builders um, consider lands to be value, and how during the recession that value had declined, and home builders just simply wrote it off. And the question really is, why and how this occurred. And really, it comes back to cash flows. Cash flows hold the answer, which is what we're going to dig into in this chapter. So let's discuss some of the concepts and skills we're going to want to take away from this chapter. We want to know the difference between book value and market value. We'd like to know the difference between accounting income and cash flow. We'd like to know and be able to explain the difference between average and marginal tax rates. And we'd like to know how to find or determine a firm's cash flow from its financial statements. So the chapter outline looks as follows. First, we'll talk about the balance sheet. Then we'll discuss the income statement. Then we'll move on to taxes and finalize the chapter with a discussion on cash flows. So a lot of this will be review. I mean, you guys, I know you just took a course in accounting, and I'm sure you're familiar with the balance sheet, um, including this definition. It's a snapshot of the firm's assets and liabilities at a given point in time. It's really a convenient way of organizing. First, what a firm owns. You can consider them to be the assets. These are the left-hand side or upper portion, and they're normally in order of decreasing liquidity. Then you can take a look at what the firm owes, the liabilities and owner's equity. The right-hand side of the balance sheet or lower portion, and it's in ascending order of when it's due to be paid. And then you have the balance sheet identity, which is assets are going to be equal to the liabilities plus stockholders' equity. So, taking a more descriptive view of the balance sheet, you can see here that we have our assets on the one side and then the liabilities and owner's equity on the other. And really, we're in order of liquidity here. And we're going to be talking about liquidity throughout our textbook. But current assets are assets with a life of less than 1 year. And fixed assets here, tangible or intangible, tend to have a longer life. Tangible assets, fixed assets, are going to be something like, a truck, whereas intangible might be something like a patent. On the right-hand side, you see you have your current liabilities, and these have a life of less than 1 year. An example could be accounts payable. You have long-term debt, which is debt not due in the coming year. And then you have, whatever is left um, would go back to the shareholders, and that's the shareholders' equity. So net working capital is going to be the difference between your current assets and your current liabilities. And it's definitely going to be an important thing that we're going to be discussing repetitively throughout the textbook. Should come back to this, and I want to highlight something, that all these financial decisions are really going to revolve around investments, which you can consider to be assets, and two, how you're going to finance those investments, which you can consider to be the right-hand side, the liabilities or the debt. So if you want to purchase a truck, for example, for your business, that might be considered a tangible fixed asset. But how are you going to finance that truck purchase? That would, depending on how you go about it, could be a liability, a current liability, if it's going to be, something that's due within 1 year, or maybe more of a long-term debt, probably more of a long-term debt. So net working capital, as I already mentioned, is current assets minus current liabilities, and it's usually positive for a healthy firm. Liquidity is the speed and ease of conversion to cash without significant loss in value. So, current assets and current liabilities are liquid. Um, it's valuable in avoiding financial distress. So, with liquidity, just consistently think cash. As far as debt versus equity, shareholders' equity is going to be equal to your assets less your liabilities. So, in a sense, you can kind of flip the equation around and solve for shareholders' equity if you wanted. Here is an example where we're looking at a U.S. corporation, which is the example in the text. And you see here your assets and your liabilities and owner's equity is on the right-hand side. We have it for 2009, 2010. And we'll take a look deeper into financial statements later, but at this point I typically ask the class, are you familiar with balance sheets? And, since you guys are all coming right out of accounting, generally the answer is yes. So this just kind of provides you with a picture of what a typical balance sheet looks like. All right, how about market versus book value? First, let's describe book value. Book value is the balance value of assets, liabilities, and equity. Whereas market value is the true value, the price at which the assets, liabilities, or equity can actually be bought or sold. So there's a distinction between the market and book value. And this is important because, accounting, you've probably heard the saying, on the books or in the books, kind of in reference to accounting. Whereas market value is more of kind of almost an economic concept. It's the true value. So book value and market value will not be equal. They're very often different. And the reason that they're often different is total assets on a balance sheet is not really a good estimate of what assets are actually worth. If you bought that truck last year or maybe this year, it isn't necessarily a good representation of what that truck is actually worth today. So the market value is really what it's worth today. The book value is what it was worth when you purchased it. Which is more important for the decision-making process? The answer to that is definitely market value. But, in order to put things into data, accounting data, we utilize the book value, and it's not worth less. It's just that the best estimate of market value, or the market value is probably the preferred estimate. Real quick example here with Klingon Corporation. This slide actually fills in all the answers, but if you can envision a situation where the liabilities and shareholders' equity, that $600 and the $1,100, the book and market values were not there, you could actually solve for those numbers, provided you know some additional information. Since you know that the total book value over on the left-hand side for assets is $1,100. You see that it's $1,100 on the right-hand side because they need to equate. If you didn't have that $600 for the shareholders' equity, you could solve for that by simply taking $1,100 minus $500, and that would get you $600. Same thing's true for the market value. If you have $1,600 less $500, you get $1,100 for the owner's equity. Bottom line is, you can go about solving for different areas within the balance sheet if you're missing something. And you can see here in this example that the market value is well above the book value. And that's important because if your books are saying, the value is $1,100, but it's actually $1,600, that could be preferential for your business and actually make your business look better or worse, depending. Now let's move on to the income statement. The income statement measures performance over a specified period of time, typically a period, quarter, or year. And you can think of, we talked like the balance sheet is kind of like a picture. You can think of the income statement more as a video recording. Um, it reports revenues first and then deducts any expenses for the period. And the end result is going to be equal to net income, or what's known as the bottom line. Dividends paid to shareholders are also reported, and as is the addition to retained earnings, which is going to be your net income less dividends. The income statement equation is the net income equals revenue less expenses. That's the key. So you guys hopefully are familiar with a typical income statement as you see here. You can kind of break these down just similar to what we did with the balance sheet, where we're looking at investment decisions, which are the top line numbers, the net sales, cost of goods sold, depreciation, and so on, and financing decisions, where we're talking about interest, taxes, and so on. So that was similar to the balance sheet, and finance is really going to do that, where you're talking about investment and financing repetitively. When we're looking at an income statement, it's important to keep 4 things in mind, and we're going to go through them now. First, the gap matching principle. This states that you should recognize revenue when it's fully earned, not necessarily when it's received. And you should match expenses required to generate revenue to the period of recognition. Another thing to keep in mind is non-cash items. Expenses charged against revenue that do not affect cash flow would fall into this category. And depreciation is the most important. Another thing to keep in mind, number 3, would be time and costs. You need to account for whether these costs are fixed or variable costs. And you also need to realize whether it's obvious, or the timing and costs are not necessarily obvious on the income statement. And that's important because, in managerial economics, we talked about the distinction between short run and long run. And that's coming into play here when they're talking about the timing and costs. Finally, 4th, earnings management is important. You need to keep in mind that there is a ability to smooth earnings, and GAAP is going to leave general accounting principles, generally accepted accounting principles, are going to leave wiggle room for that to occur. So we want to show the best to shareholders, and in some cases, wiggle room may be used to do so. Skip through this work through web. You can take a look at that on your own. Let's move into the next part of the chapter, which deals with taxes. So we use marginal rates in evaluating cash flows expected from new investments because cash flows will be taxed in addition to the existing profit. This really gets, once again, at economics. So this should be a little bit repetitive of what we talked about in economics classes, particularly managerial economics, where you focused on marginal tax rates and pretty much marginal everything. It was marginal benefit versus marginal cost, marginal revenue versus marginal cost, and so on. Marginal is the percent of tax paid on the next dollar earned. My typical approach for students to get them to understand the concept of marginal is to drill into them. When you hear the term marginal, think 1 more unit. 1 more unit. So marginal is talking about that next unit, or in this case, next dollar earned. What's the percent tax on that next dollar is what marginal is referring to. Average is going to be the total tax bill divided by your taxable income. So if you're considering a project that will increase taxable income by $1 million, which rate should you use? You should use the marginal tax rate. So let's do a quick example. Suppose you have a firm that earns $4 million taxable income. What's the firm's tax rate? What's the average tax rate? What is the marginal tax rate? Let's walk through this example. So here is your solution to that. And I believe you have a homework problem that's very similar to this. So let's walk through it. Okay, so the first thing you notice here, let's start at the top where it says corporate tax rates, and then you have taxable income levels, and it has kind of a dash there, and then it has to 50,000. So that's saying if you made from 0 to 50,000, you would be taxed at 15%. Okay? So the taxable income, 50 less 0 is 50,000, and the tax liability would end up being $7,500. Let's move on to the next one. Let's say you made 55,000 or something in that range of $50,001 to 75,000. Then you would be taxed on the first $50,000 at 15%, like we just said. But that additional income, let's just say it's 55,000, that additional $5,000 over 50,000 would be taxed at 25,000 or to 25%. So, if you made $75,000, for example, your taxable income here would be 25,000, which is the 75 less 50, and your tax liability would be the point. You would take 25% times that $25,000 and you get $6,250. You can probably see how this is working. Next grouping is 75 to 100,000. That's taxed at 34%. And you know that 100 minus 75 gives you 25. The tax liability will be 34% times that 25. You get $8,500. Keep going down. 100,000 and between 100,000 and 335,000 is taxed at 39%. Taxable income there is 235,000. The tax liability, 39% of that would be 91,650. Now, the example that we gave, we said the tax liability was $4 million. We said that the firm earned $4 million. So they would actually fall between this 335,000 and 10,000, right? 4 million is in that threshold. Therefore, that ending amount would be taxed at 34%. The tax liability would be $3,665,000 times 34%. You'd get $1.246 million in tax liability. Now, as you see here, they then take all those tax liabilities, the 7,500, the 6,250, and so on, and sum them to get 1,360,000 in tax liability. Okay, and from that you can obtain your average tax rate by taking that 1.36 million over the original 4 million, and you get 34%. That's where that average tax rate is coming from. The marginal tax rate is known right from the get-go. You know that 4 million falls between that 335 and 10 million threshold, and it tells you 34% is what you're taxed on that last dollar. So I think there's a homework assignment on this. If you want more additional information here, I would focus over here on this Excel sheet. You can click on it, and if you have any questions about how we just walk through all this, you can click on this Excel sheet and go through the formulas and find out where all the information is coming from. Okay, let's move on to the concept of cash flow. Cash flow is one of the most important pieces of information that can be derived from financial statements. The accounting statement of cash flows does not provide the information that we're trying to that we're interested in finding here. Our focus is on how cash is generated from utilizing assets and how it is paid to those who finance the asset purchases. So this next section, I'd like you to pay attention to this, but I don't want you to get overwhelmed, particularly because it's going to be more difficult to do this via a presentation. Typically, I would write things down at this point, but I'm not going to really have the ability to do that. Actually, maybe I can use Word to kind of write these formulas out. But I do want to stress that this next part to close out the chapter is not a part that I want you to necessarily memorize or anything like that. It's just a good idea to go over this at this point, because as we move forward in the chapter and chapters in the course, you're going to need to know, okay, what is cash flow? And right now we're going to show you how you obtain it. Going forward, we're never going to have to do this again, but it's important to just kind of demonstrate that to you. So while I set up the cash flow from assets, just bear with me for a second. I'm going to try to open up a Word document. Actually, let's open up an Excel sheet. And in this Excel sheet, we'll talk about some of the formulas that we're going to cover in our PowerPoint presentation. So let's start off. Cash flow from assets. That's going to be equal to your operating cash flow less than net capital spending less changes in net working capital. Now, once again, you don't need to necessarily know these formulas going forward, but it's good for you to have an idea of how this information is obtained, and it's all obtained from accounting statements. So let's move over to our Excel sheet. I can tell you that your operating cash flow formula, you're going to take your EBIT, which is earning before interest and taxes, add your depreciation, and less your taxes. So that is this part of the equation. Now we need to move on to net capital spending. Net capital spending is your ending fixed assets less your beginning fixed assets plus depreciation. That's that part. Then we needed changes in net working capital. What is that? Well, we can get our ending net working capital. To remind you, net working capital is your current assets less your current liabilities minus your beginning net working capital, current assets less current liabilities. Okay, so that is all the information that we need to calculate this. Now let's go back to this real quick and just look at what we talked about. EBIT, depreciation, taxes, all information that are within your financial statements. Ending fixed assets, beginning fixed assets, depreciation, all information in your accounting statements. Net working capital, whether it's this year, the most recent year, or if it was last year, all information in your accounting statements. So when we're calculating our cash flow, we're obtaining all of the information from our accounting statements, which is why we have Chapter 2 in our textbook. It's telling you that all that accounting information that you did in your accounting course was relevant for finance. We're now using that data to formulate our cash flow from assets. There's another way to calculate this. Same thing, and it should yield the same exact results. You could do cash flow from assets is equal to cash flow to creditors plus cash flow to stockholders. Same idea here, except now we need to go through this and this. So let's talk about cash flow to creditors first. This is going to be equal to your interest paid less net new borrowing. So this is your interest paid less your net new borrowing. Real quick, what's net new borrowing? Is equal, that's going to be your ending long-term debt less your beginning long-term debt. Okay? So that's the cash flow to creditors. How about the cash flow to stockholders? This is your dividends paid less net new equity raised. What is your net new equity raised? That is your ending common stock, AIPC, which is your additional paid-in capital, and treasury stock, less your beginning common stock, AIPC, and treasury stock. There. So let's go back to this real quick. This was broken down here, and this part, the cash flow to stockholders, was broken down here. And the point being that if you go back in the video, you can check that out again, that all the information for cash flow to creditors or cash flow to stockholders is coming from, again, your accounting statements. So once again, do you have to memorize these equations? No. Is it good for you to understand that the data is coming from the accounting statements? Absolutely. So that's the point and why we're going through this now. So you could literally take your balance sheet and your income statement and calculate your cash flows. And that's what they do here. They take the information from the existing balance sheet above and the U.S. Income statement for a U.S. corporation. They take all the information out and they calculate their operating cash flow, their net capital spending, and their changes in net working capital. You can go through that line by line if you'd like. Try to find each of the numbers, like 694, for example. Your EBIT would be located over here. Your depreciation, where do you find your depreciation? 65, right there. Taxes, 212, right there. So you can go through the rest on your own, and you find all the information from your accounting statements. You utilize the equation to come up with your cash flow of $87. You could use the other equation as well, finding the information from your balance sheet and income statement, and guess what? It comes out with the same exact answer, $87. So this summarizes everything we talked about in that Excel sheet, okay? And we're going to end the class there. Just to recap, the importance of this chapter was really to describe the fact that accounting data is used to within finance. We'll pick up with chapter 3 next.